What is going on, ADPI Nation? This is your host, Kevin Brenner, and I have another fabulous episode for you of the Active Duty Passive Income Podcast. That's my late night DJ voice. I'm going to start talking like this all the time. I think my wife will kill me. She's not into that. My guest today is Tyler Carney-DeBord. That is a lot of names for one person, but this one person is very, very, very important. And today, we are going to talk about the world of commercial real estate lending. So if you're a longtime listener to this podcast, you probably understand like, hey, how to get a conventional loan. Well, to get my next 1 to 4 unit property, you use your VA loan. If you're going to house hack it, you got your conventional stuff. Maybe you might be smart on your Disker stuff and your non-QM loans and maybe some hard money and this, that, and the other. What we're going to turn our focus to is how people do these big deals, these commercial deals. Because no one's going to Tyler and Tyler shop and saying like, hey, see that 119 unit complex in Texas? I'm going to use my VA on that. That ain't happening. So Tyler, welcome to the show, brother. Glad to have you. Long time.
Yeah. Good to catch up with you, Kevin. Good to be here.
Yeah. So Tyler, tell me a little bit about just the world of commercial lending. I would love your perspective because you've been on both sides of this. You've been in real estate for a long time now. Tell me your perspective, as far as like residential lending versus commercial lending. What are your big time like industry differences here?
Yeah, sure. Well, first of all, I want to say thanks for having me. And for the ADPI Nation that doesn't know me, I actually was never active duty. The way I got connected, both of my grandparents were, as many were, and much of my family, and so it's a big part of my heart. The way I got connected was when Markion, your CEO, was looking for his first commercial real estate deal with Natalie. And actually, he was shopping with a broker that I'll name drop here. His name is Charlie Gagliano out of the Cleveland office of Marcus and Millichap. Mm-hmm. And Markion met Charlie and I about the same time, and Charlie hooked me up with Markion. He ended up not buying in the Cleveland area. They ended up buying a couple deals in Indianapolis, and then the ADPI group did their first syndication shortly thereafter in a similar market in Indianapolis, which I think you guys cover on a case study.
Oh yeah.
So I did the lending for that case study, which was so cool. And then years later, I started to get more and more clients in Eric and Markion's circle, and I just stayed right in touch. And so I was at ADPI Con. I'd like to say I'm one of the biggest fans. So that's me in a nutshell. And then real quick too, I always start before I get into commercial lending. Tyler Carney-DeBord is a lot of names, and all credit of my career goes to my mom. My mom's in this picture here. She was a very successful college basketball coach. That's a championship picture there. And if you look her up, she is one of the most successful athletic directors, Nan Carney-DeBord, in the country in college sports. And so she wasn't somebody who was going to give up her name in 1980 when she started her career. So my mom and dad are Carney-DeBord, and I'm Carney-DeBord.
There you go.
So that's me.
That's awesome.
Yeah.
And for those who attended ADPI Con, you dropped some serious knowledge bombs on on just the world of commercial lending and everything, and it was super, super cool. And I trust that you'll be here next year. Well, it is next year. It's 2023 at ADPI Con 23. Guys, I'm going to throw this out there on the podcast listeners right now. We're picking locations now, and it's really exciting. We kind of have it narrowed down, and that's all I can tell you. Okay, I'll tell you more. We're picking between San Antonio, Atlanta, and Nashville. Okay, that's all I can tell you.
I love that.
More to follow. ADPI Con was a smashing success, and it was so much fun. And we literally changed
really was.
Lives. Yeah,
really was. And to start on commercial lending, Kevin, I think Really, the number one big difference is pretty much, we can get into recourse or non-recourse, but pretty much if a lender is going to foreclose or take a loan back, and that's where really lending starts. What's the risk?
Mm-hmm.
So if a loan totally goes bad in commercial real estate, they pretty much are only taking over the asset of the commercial real estate and the ability for it to create cash flow if they foreclose on it. They really, most loans, the loan I did with Markion and Eric, were both non-recourse loans. To go real quick, non-recourse means you're not personally guaranteeing a loan. If the loan forecloses legally in the loan docs, all the lender can do is take the building back. So all that really means is in commercial lending, lenders are stressing cash flow much more than they're stressing your credit score, your history, your how much money you make, what's really on your tax return. Those factors that are sort of difficult in residential lending are actually not very difficult in commercial lending. Commercial lending has another set of challenges, but that's not the biggest difference. Is they're underwriting the cash flow of the real estate, not necessarily the sponsor so much.
Right. Yeah, that's a super huge point, recourse and non-recourse. So flipping the script, if we say, let's say a regular conventional investment loan, it's under Kevin's name, and I go and buy a duplex somewhere, right? And I use this conventional product. It's in my name, and I default on the loan. They're going to take the house, and
Right.
they're going to tank my credit score, and
Right.
all that personal stuff is going to be affected. But
Yep.
because the way, and what you're saying, Tyler, and I'm just kind of reshaping it, because the way commercial real estate is evaluated based on
Yeah.
its net operating income and cash flow, and you're really buying a business, right?
Right.
Because of that, these loans are non-recourse, and that's why they're looking more and more and more at the business side of it and the business fundamentals of that real estate. And that lender, and correct me if I'm wrong here, but that lender is going to care way more about your business plan and how you, if it's a value add multifamily, how you intend on improving the net operating income or your bottom line cash flow, right? How you intend on improving that versus, like you said, like your personal credit score.
And all of the details of all of how you're going to improve it. Has anybody ever done a similar thing in the market before? Are there market comps that support these improvements in the rents you're going to get on the other side, or the sale value you're implying on the other side? Are there comps there? They're going to really dig in and find that out. Have you ever done this value add before? Do you have it? Who the heck is going to do it? Who is the property manager who's going to execute it? How long are you planning on doing it taking? Like, all of these intricacies are really, that's all the business plan. So you're right, Kevin.
Now, would you say, Tyler, that a commercial loan, a non-recourse commercial loan, is there more flexibility in that versus, say, a conventional loan that has, kind of the bank, what are they called? Like the rules that the bank uses. Like there's the rules that the VA uses, and then there's the subset of rules that the bank uses. And
I guess the credit box, or
like the, I forget what they're not called, limitations, but like the bank sets certain rules on what they'll approve and what they won't.
Yeah.
But would you say there's more flexibility in these commercial products?
Flexibility is a lot of, like, flexibility can be a lot of things to a lot of.
Yeah.
When I talk about flexibility in a loan, what I actually am referring to in my business is how swiftly you can get in and out of it. I think what you're talking about more is how do you get approved for it?
Right, the approval process, yeah.
Yeah,
so maybe flexibility in the approval process.
Yeah. So I would say the way it's more flexible is you can really remarkably and it's the best thing I can say in this podcast or in anything. You can buy deals with almost no money down, with almost no experience. Really, probably not by yourself. You probably need a good team. And I think the community at ADPI is like a great place to start. There's a lot of people out there in the world who will provide their balance sheet as the experience part of the requirement. And then you do those things, you have a good business plan, you show what you're doing. Yeah, you can, it's more it's just more possible. Whereas you might just get tripped out by bureaucracy or some rules that a bank has, or while they're looking at your credit score on a duplex.
Yeah.
So
Yeah, and I love, commercial real estate. We kind of sing it from the rooftops at ADPI, especially if you're part of the Military Multifamily Academy. You know this, and hopefully, the recording of this podcast, literally last night, Tim Kelly just did the 2023 Military Multifamily Investor Power Hour, which is like Tim, who is like probably the busiest man on earth, carved out an hour of his time to go and coach soup to nuts like how to do multifamily, and we had, God, 500 people on that call, so it was nuts.
good for you
but
guys.
Anyway, we talked about that yesterday, and the thing I love about commercial real estate is the economies of scale, right? And that's why when I think of flexibility, and you kind of hit on that point on the approval process, it is there's so many different levers to pull, and you're right, a lot of the times you don't have to fall in this bureaucracy. I would say that each commercial deal is can be unique in its own way.
Yeah, and you can get really creative. There's a lot of lenders in the marketplace, a lot of capital in the marketplace, all the way down to, there's HUD lenders that are the most detailed people of all time, and it takes a year to close and probably 5 years off of your life in stress. but it's a 40-year fixed rate for, today, probably 4.5%, which is, probably about a full percent less than the rest of the market, fixed for 40. So there's that end of the spectrum, all the way to the other end of the spectrum where there's lenders that'll close in 5 days with almost no tax returns on a hotel conversion without any cash flow.
Wow.
I've closed both of those type of loans this year. So so it can get very creative really quickly.
Yeah. And yeah, so that's one part about the commercial lending that I kind of appreciate. Obviously the non-recourse, we talked about recourse and non-recourse and how important that is. When you are talking to new investors, maybe not new investors, or just potential clients, right? You're talking to clients who are submitting a loan package, or they need lending. What are some
people
of the
starting
biggest,
at the beginning their syndication
people starting
career?
Anyone kind of, maybe that's new that you're talking to. What are some of the biggest mistakes that you see them make when, as far as the funding side of things go? And is there some, like, are there some things that they're not looking at in their due diligence that you're like, man, I really wish they would have looked at that? Because sometimes like you're working with a lender and it's like, oh, you got to do this piece. And you're like, oh crap, let me go back to the property, do that due diligence, get that information for them. Like, how can we streamline that process for folks listening to this podcast?
Yeah, I would say really the number one thing, we just talked about how all these loans are based on cash flow, right? So the number one thing you can do as a beginner investor, whether you come to me or you're looking at it kind of yourself, the biggest thing you can do is really to practice underwriting cash flow. The biggest mistake people make is we go to the ADPI conference, we know that underwriting is important. We learn it from Adam Labar, and we learn underwriting is important. We do the class in an hour, and we know underwriting is important. Then we get a deal that's hot and exciting, and we just forward it over to Tyler or whatever other lender. And frankly, It's amazing how many of my clients don't do real good underwriting or don't do underwriting, and to the basics. So I would say practicing the underwriting the cash flow, and we could get into the mistakes everybody makes on the underwriting the cash flow. I think the number one mistake is too much underwriting to a pro forma instead of in place what it is today. You might have a pro forma, but the lender doesn't really care about that as much because that pro forma doesn't cover cash flow today. Bridge loans are a little different. Construction loans are a little different. But at the end of the day, you got to have a good solid handle on what's the NOI going to be here the first day we take it over. And if you're asking for a loan where the payment is going to be more than the NOI, well,
that's a problem.
It just better be a really good reason. It better be a really good reason. Like, we're getting the cash flow up to positive in 1 year, and this is how we're doing it. Or the owner was really struggling with this, and it's really obvious, and so we think the rent roll can quickly be this,
right,
or whatever. But for you to just have no awareness of what the payment is compared to the NOI is really just irresponsible. You can't really start talking about lending.
It's lazy. It's lazy.
Let's just be honest.
It's just lazy.
So and you get too excited in all the other steps of, because you might the first time syndicator might have 5 jobs. They might be negotiating with the broker, talking to the insurance person, talking to a construction person, or whatever, right? And so underwriting gets lost and all that. You just forget.
And that's why we say real estate is a team sport, specifically commercial real estate. When you have a team of 4 to 5 people on your capital group, your syndication group, everyone's got a defined role. You got your capital raiser, you got your asset manager, you got your underwriter, you got your, you got those team members in place. So it's not just like an overwhelming amount of, weight on one person's shoulders. Because honestly, it's pretty impossible, because we didn't even talk about, and this is not this episode, but we didn't even talk about bringing the SEC on, having the lawyers do the PPMs, and that's a whole nother animal that takes a lot. I mean, golly, we're going through the Reg A process on ADPI Capital, and it's just like, we've been working with our SEC attorney for over a year now.
Right.
So that is that's a whole thing. So this is super interesting, and gosh, I want to get real with you, Tyler. Real talk.
We'll get real.
Okay, so looking at the commercial real estate market right now, I see a couple things. And this is not just like Kevin's viewpoint. This is like, I've talked to a bunch of brokers in my network and all of this stuff. And what they're seeing is this. Brokers, not mortgage brokers, I'm talking commercial real estate brokers.
Sales brokers. Yeah.
Mm-hmm. They are salivating. And I'll tell you why they're salivating right now in the market. Because about 2 years ago, maybe a year ago, you have these newbie syndicators, and they have the bridge debt, and it's all fine and dandy until those bridge debt payments come due, because it might have been interest only for like 2 years, and then your principal comes in, and it really messes you up. So they were thinking, I'm going to refi, it's going to be fine, it's not going to be a problem. Well, they can't refi now because the interest rates have gone up. So they're facing, what do? If you can't refinance, and your cash flow, if you haven't, like you said, Tyler, if you haven't brought the net operating income up where it needs to be, then you're not going to be able to cover your payments. You're pretty much going to be underwater in your own commercial property. Well, these sales brokers out there are salivating, because they're like, hey, let's get to these people before the banks do on the foreclosure process.
Right.
And we can have them fire sale it.
Yep.
And so what does that mean for people listening to this podcast who are putting together their syndication teams, and they're in the multifamily space, and they're actively looking for deals, and maybe they've had their pencils down for the past 2 years because it wasn't making sense? Guys, it means that deals are coming back on the market, and you have to do the right thing, and you have to underwrite them smartly, and you have to look at all the angles and understand your capital stack. You can't just get excited and say, oh yeah, I'm just going to throw some bridge debt on there, to get the deal done, because that's what everyone has done. And, they screwed themselves. So thoughts on anything I just said, time to
Yeah.
go.
Yeah, I mean, that's a big topic. I mean, that whole theme that you are bringing up is probably one of the biggest topics at the NMHC conference coming up next
Mm-hmm.
week, which I'll be at, which is just the amount of bridge debt I think I've heard in the marketplace that's outstanding that you're referencing there. The number is like something like
It's got to be
10
trillions.
billion.
Oh, billions.
Yeah, it's
Jeez.
billions and billions. So it's been done a lot. I'll make like one correction that's actually even a little worse than how you described it. Most of the bridge debt, you don't even get a chance to start amortizing. You balloon.
Oh, so
So
it's not even a principal at the end of the IO, it's a balloon?
it's IO, you don't pay down for 2 or 3, and you might get an extension to 3
Sure.
years. But if you didn't make any improvements, the lender's not going to give you an extension,
Sure.
right? So it's like 2 years. At the end of the 2 years, you owe the amount you borrowed, and rates of that example. Bridge debt's floating, by the way.
Mm-hmm.
So in 2020 and 2021, when I was not at Atlas yet, I was actually at Marcus and Millichap, but we closed something like 40 bridge loans
Wow.
because the pricing was 300 over or 350 basis points over. That
Mm-hmm.
basis points means 100 means 1
100th of a
point.
percent.
So
Yeah.
that's 3.5% over the 30-day SOFR. The 30-day SOFR is what's affected by the Fed.
Mm-hmm.
30-day SOFR in 2021 was 0. Today it's like 4.5 or 5.
Mm-hmm.
So that 3.5% bridge loan became 8 on the same balloon payment. And that's happening all over the country. Everybody is asking me, is there any creative ways to refinance? And then, I mean, to answer on how it'll play out, so far, all of those sellers have still thought their property is worth whatever it was when they bought it in 2021.
Mm-hmm.
And the problem has been they just don't list it for sale for anything less than that yet. So I haven't seen a lot of cap rate adjustment like yet. But I hear you in that the brokers are waiting for it, like it's this pent up. Somebody's going to have to force the sale, or investors, bank, somebody, before
Yeah.
they're really going to start taking haircuts. But for the group, no doubt about it. And really, my opinion on commercial real estate is you have to be active in all markets,
Yep.
just like a habit. Like I bought a deal last year. I bought a deal the year before. I bought a deal the year before that. I'm trying to do a little bit more on the personal investing side than one a year. But the point is, you can't really necessarily time markets. You have to just be involved for years and years. And if you like Markian and Eric in Anderson, Indiana, if the market takes off, you sell.
Yeah.
If the market doesn't take off, you hold for a longer time, whatever. But you're just active in all markets, I think, and you underwrite them one at a time.
Yeah. And that's honestly, that's when we talk about, hedging risk. Because I have so many people talk to me about the fund and how to build a fund. Oh, well, why don't I just build a fund? And then we're investing in all the markets all the time. Well, yeah, that's what we did at ADPI. Good luck. I wish you the best. It took a year. So like,
Right.
Right. but that is an aspect that we'll have to talk about later on. I think, gosh, I just learned so much just about kind of how these bridge loans work. And I had no idea that I knew they were floating, but I didn't know they ballooned.
Yeah, a couple more fun facts about them that are really scary. They say they're non-recourse, but if you read the loan documents, I think 9 out of 10 of them are non-recourse until the property has bad cash flow, then becomes recourse.
Wow, get out of here.
which to me is pretty hilarious because why would you ever care about the recourse if it had good cash flow?
Exactly. Yeah, that makes no sense.
Yeah. So they slipped that out there in there. I would say most of the bridge loans are hard recourse. And then the other thing that's crazy about the bridge loans is there's this whole thing called the CLO market, collateralized loan obligation. That's commercial real estate's mortgage-backed security.
Yep.
So these bridge loans were packaged up and sold. Now there's a special servicer. The special servicer isn't the original relationship that you might have had with your friend, the loan originator at Arbor. I'm making a name up. And Arbor's a good lender, by the way. So, but the original contact you had to put your loan on it is not your contact now that in servicing. So you can get in. They've been they're pretty aggressive.
Wow. Yeah. So, gosh, I mean, it's just this stuff it's like a whole nother animal for folks. So,
sure.
As far to put a pin in this conversation on the bridge loans.
Yeah.
Bridge loans, they can be useful. They are quite scary now, and people
they can be very useful. I've used them, and the number one thing really is you just like a bridge loan is always two pro formas, as is cash flow, as stabilized cash flow. If you are 100% confident you're going to get there, if the rents are in place $800, and for it to work, you only have to get the rents to $1,000, and you can get that bridge loaned out. And the market rent is $1,200, and it's so obvious that you're
golden.
Then that bridge loan is actually better because it'll provide you more money. Really, you can borrow more than a permanent lender, and you don't have to raise as much, which is better for your capital to stack.
And that is the next point I wanted to hit on in the limited time we have left. How can people, if they want to get into commercial real estate and they have their team set up, then if bridge loan is off the table, say just because, who knows, they're not comfortable with that recourse flip, which is kind of shady, to be honest, and I don't blame them. How can they get into these deals? Well, the big problem, of course, is you're going to need 25% down, or maybe is it what is the down payment on a agency debt these days?
So
20, 25, 30?
Well, so that's just it, right? So and we're going to have to show this on a screen somehow, either in one of the education sessions or somehow, because this is just it. The agency debt, the down payment is based on a 125 debt cover on the cash flow, not necessarily the loan to value. In 2018, 19, 20, and 21, nobody ever cared about that because they would borrow 80% loan to value and it cash flowed no problem. Okay. Now, interest rates they've been hovering around 6. We're at 5.5 now. But the price is still a 4 cap. And so when you compare net operating income to the loan payment, it never is more than 80%. It's never more than 70. Most of the year it's been about 50.
Wow.
Yeah, most of the year it's been about 50, really, on agency stabilized debt. And so if you want to go agency, you're raising the other 50, which we've done a few of this year. But that's just really conservative. Like you have to have investors that I would say are just patient there and aren't chasing cash on cash, or chasing really a long-term hold. If you have investors who expect their money back real quick, that's harder. Yeah. So that's been the problem. So it's been 50. You either get 50% loan to value agency, or you get 75 plus the renovation budget bridge.
But then bridge has, like we talked about, bridge has its risk factors as
well. Only 2 years. Yep.
So it's weighing out your options here, and I think you hit the nail on the head based on when you're capital raising and you're talking to folks. If you don't have that strong relationship with with your folks and they're working with you on this project and they're like, oh, well, I just want my money back in a year or 3 years, then they're going to expect you to get bridge, refinance the bridge, and cash them out. Like that's what they want.
Or if it's the first time they ever invested in a deal in their whole life, then they put it in, and in 2 years they kind of wonder where their money's at.
Yeah, like, 100%.
You know, that's tough.
Yeah. Man, this is such an interesting conversation.
Yeah.
So yeah, I talking more about these debt structures, and then of course, like we just talked about, just summarizing here, when you talk about if you use agency debt, it's 50% loan to value. That means that you need to bring 50% to the table a lot of times in
a lot of times because of the debt service coverage ratio relationship.
Right. Yeah. So you got to bring 50%. So if you're doing a $10 million deal, that means you got to raise $5 million
plus close it, plus
closing,
plus have your acquisition fee, plus your money in the bank. So you're probably on the $10 million deals, you're like raising 6.5.
Wow.
Or whatever.
So raising 6.5. Yeah. Whatever that comes out to be. So raising $6.5 million to make this happen.
Right.
The big, I want to circle back to what we were talking about, the problem with bridge in today's market and bridge debt. A lot of these new syndicators who came out and well, guess what? They raised the capital, so they have investors. Well, there's a lot of folks, including some folks in my personal network, who invested a couple, maybe 25,000, 50,000 here, whatever. They just invested in some deals, whatever, as an LP, which is a limited partner. And some of them now are getting emails from these operators pretty much saying like, hey, we didn't expect interest rates to rise this much, and we're having trouble getting out of our debt and restructuring our capital stack, and you might not get your money back, and we might not be doing distributions when we say we would. But for those folks, you were talking about earlier, Tyler, they're still valuing their properties at what they purchased at. So unless someone forces them, aka the bank, forces them to
bank or pref equity or
someone,
somebody
like
in investors,
the money, someone in the capital stack, like a big investor, unless they go and they're able to force that sale, then that the cap rates might start adjusting a little bit. But until that happens, and obviously these syndicators don't want that to happen because number one, they're probably not going to get paid at all. They might be able.
They might not ever do a deal again.
They might not ever do a deal again. They might be able to get their investors paid, maybe like made whole again, not like making money, just like here's your initial money back, I'm out. But from a reputation standpoint,
right,
I would say the reputation's pretty much screwed, like among investors. And you're right, they might not have the confidence to do a deal again. So.
And I would say that's the high stakes of commercial real estate right there. Like that's just it. Yeah. Although even if it's non-recourse, trust me, if you give one back, it follows you for a while.
Yeah. Because everyone kind of knows everyone in this industry. The higher you get up and all of that. But ultimately, what I would say that I don't want to scare people away from commercial real estate because the benefits are there as well. It's all about putting your team together.
That's right.
Identifying a deal, underwriting the deal, and getting a business plan and implementing that business plan. Because if you go with bridge debt,
brother.
If you have 2 years to go and implement your business plan, and like you said, okay, I got to raise rent from $800 to $1,000. I know that market is $1,200. You can do that in 2 years. That's not a problem at all. But if you're underwriting a deal and it's like, all right, I need to get from $800 to $1,200 for this to make sense, and market rent
and they already renovated it once.
Yeah, and they renovated it 3 years ago.
Right.
Then you're just picking up someone else's scraps. It's a crap deal. So the lesson here is don't force your deals. Be patient. Underwrite appropriately. Underwrite conservatively. Stop drinking the Kool-Aid with the 3% year-over-year rent growths. Stop getting into silly capital stacks. And
no doubt.
Just be smart about this. And of course, talk to someone like Tyler. So,
and I'd say get to know, we talked about start to really prep your investors on what their objectives are. We talk about that in capital raising, but also for debt. Because then you can really go to a professional like me and actually say, we want 10-year fixed rate money because our investors want to be here for 10 years. And that's it. They're really conservative. They don't, all the other bells and whistles, we actually want to take risk off the table, or 7 years, or whatever it is. And that's what I would say. Start there to try to get your objectives really narrowed down on how long you want to hold it, and how you want it to look, when you want to pay people back, and then you can start to figure out what type of loan you want to have.
Fabulous. Couldn't have said it better myself. Tyler, we gotta jump, man. We're gonna have you on a follow-on. I'm gonna take you to the bonus round just like I do everyone else. But I got some deals that I need to talk to you about. And if people want to get in touch with you in the community to talk to you about commercial real estate and they've done their underwriting homework, how can they get in touch with you?
Yeah, absolutely. So real quick, after a 8-year career in mortgage banking at the big firms and working my way up to vice president, last year and the year before, my partner and I started Atlas Real Estate Capital. Let me see if I can get. Here's our
letterhead
sign.
Oh, there you go. Oh, you still got it. The gold sponsors. Yeah. There you go.
So Atlas Real Estate Capital is us. My email is just tyler@atlasrecap.com. And that's really the easiest way. I have a calendar and we can get something on the calendar.
Perfect, man. I'm gonna be shooting you an email as soon as I possibly can because I need some money.
That's right. That's what we're here. Financing available.
All right, Tyler, man. I appreciate it. We're gonna have you back on soon, brother.
All right. Thank you.
I'll see you then.